What's up everybody, welcome back to the channel. I'm Shawn GILL CPA with Neutron Tax. Let's talk about medical expenses, healthcare, and how to save thousands on taxes super easily. I know I look a little bit younger, I shaved my beard, but I still have infinite tax knowledge. Let's go to the desk. So if you live in the United States, you probably know firsthand how high our medical expenses can be and how high our taxes can be. Luckily, the good news is we can use both of these things intelligently to offset one another. Now, there's a couple different strategies that can be used to do this. I'm going to cover first the most commonly known and kind of the worst one, which is writing these off as itemized deductions. So one, for this to work, you have to be able to itemize, right? Meaning that your itemized deductions have to total more than your standard deduction. Well, after the Tax Cuts and Jobs Act that passed in 2018, the standard deduction has gone up for everybody to the point where most people that used to itemize actually can't itemize anymore. They just get so much more from their standard deduction that their itemized deductions aren't outweighing the standard deduction. On top of that, if you're trying to deduct out-of-pocket medical expenses, these expenses there's a floor for them, which is 7.5% of your AGI, which is your adjusted gross income. This means the more money you make, the higher this floor is, and the less of your out-of-pocket medical expenses you can actually write off for tax purposes. So your itemized deductions are taken on your personal return. This is on the 1040 on the Schedule A. That's the worst way to do it. We're not going to talk about that. Just don't even go there. There's better ways to do it. So one thing I see often is new clients of mine, I take a look at their tax returns and I see that they have tons of medical expenses that they're trying to write off on their Schedule A, but they actually don't qualify to take out because they're just not accumulating enough itemized deductions for it to outweigh their standard deduction. I actually had a client this year who had $23,000 out of pocket in medical expenses because their son was diagnosed with some special disease and their insurance didn't cover all of it, so they had to pay a lot of money, out of pocket. It's not a unrare thing in America, but unfortunately, because of the way our healthcare system works and our tax system works, they actually weren't able to take any of that against their taxable income. So they got no benefit for paying $23,000 out of pocket. So we want to avoid this. So the first strategy to help avoid this and to deduct your health expenses is, if you're a business owner, you should be paying for all of your health insurance through your company. This way, your company can write it off as a deduction, and then you still get the coverage. This can depend, the best way to do it for most companies. There's a couple different nuances here with entity structures and things like that, and we can talk about that if you book a consultation with us, which there's a link in the description to do. But for the average person, and in most cases, the general rule is that you should be writing this stuff off through your business, through your LLC or your S Corp or your C Corp. And if you're not a business owner and you have a 9-to-5 job, that's great. That's actually even better because you're not paying for your own health insurance. Your employer is taking on most of the cost, but you can use this next strategy to lower your taxable income as well. So let's talk about HSAs, or health savings accounts. These are basically tax cheat codes. This is a quick and easy way to save multiple thousands of dollars on your tax return, and they're actually relatively simple as well. So what is an HSA? An HSA is essentially just a bank account that you put money into that you plan to use later for your health expenses. So this is money you're going to spend anyway on different healthcare costs, your co-pays, any out-of-pocket expenses. You need to go get blood work done and it comes out of your pocket. You can use your HSA for that. So think about this as you put money in this bucket that you get to use for health expenses, and then you write that off for the year. For 2022, if you're a single individual, you can deduct $3,650. In 2023, that jumps up to $3,850. And now if you're filing, let's say married filing jointly, or you have a plan that covers your family, just double those numbers. So for 2022, that's $7,300. In 2023, that's $7,750. So that means you can take a deduction for around $3,600 to $7,700 on the high end for literally just saving money to pay medical bills. You're going to do that anyway. But if you do it this way, we move money around from one area to another area. You can very easily, very cleverly, I don't know if cleverly is a word. Sav?
I think so.
He thinks so. You can very cleverly. So this is a super easy way to save thousands of dollars on your taxes, and all you're really doing is moving your money around from one place to another, and you're being clever with how you move it around. Okay? This is nothing super complicated. And then another great part about this is that there's no income phase out. So this means if you're a high earner, you're not being punished and penalized by not being able to take this deduction. You can get this benefit if you're making $5 million a year or $50,000 a year. All right, as long as you can afford to move the money into your HSA, you're good to go. And another great thing about HSAs is that there's no timeline for how long you have to leave the money in them to get the tax benefit. You could put the money into this account on December 29th, 2022, get a deduction for it, and then use the money, pull it out January 7th, 2023, use that to go, then pay for your eye exam or whatever you have to get done, get your copay paid. And you still get the tax benefit, and there's no tax hit when you pull the money out. Unlike an IRA, right, where you get the deduction when you put the money in, and then if you pull it out early, there's a 10% penalty. There's no penalties with HSAs. The only thing you have to make sure is that your health plan is a high deductible plan, your healthcare plan. Now, in the US, this is not hard to do because according to the IRS, what they deem as a high deductible, if you're single, is $1,400 in 2022, and for 2023, it's $1,500. And then again, just double that if you're not single, if you're married filing jointly, or you have a family-based plan, that's $2,800 in 2022 then, or $3,000 in 2023. For the average family, you have a high deductible healthcare plan according to the IRS, meaning you qualify to have an HSA. And then to set up your HSA, all you have to do is contact a bank or a healthcare provider. You can literally just Google how to get an HSA, and there's multiple options that within a couple minutes you can get this plan set up, make a contribution for the year, and save a quick $3,600 to $7,300 on your taxes this year. Clean, simple, not hard. You can also do this up until the actual tax deadline next year. So you can take this deduction April 14th, 2023, and get that benefit for tax year 2022. Okay, and if you extend for your taxes, if you extend to October 15th, 2023, you can do this before then, and it still counts for 2022. The only condition is you have to have that high deductible health plan established during the 2022 tax year, preferably before December. There's some technicalities that pop in at the end there, but for the most part, if you have this plan during the year, if you set this up today, you can benefit from this and have up until the next tax deadline to actually move the money around to qualify for that deduction. And if you have any questions or comments or issues around this, feel free to leave them in the comments section below, and I will either give you an answer there or tell you to give me a call, and then we can talk about it in detail. But I encourage everybody, especially small business owners, to pay their insurance through their business if you have a business, or at the very minimum, have a health savings account, an HSA. It's easy money, it's free tax savings, and you're gonna use the money anyway to pay your health care. We don't live in a world where you're gonna get free health care anytime soon, at least in the United States. So might as well save on taxes. So that was the end of this video. If you liked it, please give it a thumbs up, subscribe, leave a comment. It helps me grow the channel. If you need help with your taxes, you can book a call with me directly at the link below in the description, and you can also sign up for our email list. We only send out an email about once a month, and that's everything I need to tell you. So I will see you guys in the next video. I'm out. Peace. Have a good day. Appreciate the views.